Seoul has officially confirmed its upcoming high-level trip to Beijing, a meeting that signals a significant shift in diplomatic priorities. The agenda is laser-focused on the economy, technology, and, most critically, supply security. This is not a symbolic courtesy call or a routine diplomatic exchange. Instead, it's a deeply practical, operational move, driven by intense pressure from industry leaders to tackle the very real cost overruns and logistical nightmares that companies are facing in the wake of recent US tariff changes. At the heart of this decision lies an urgent need to secure supply chain stability, diversify critical trade routes, and ease pressure on congested ports. Although the US recently reduced some tariffs from 25% to 15%, the core problem isn't the specific percentage, it's the persistent uncertainty and policy volatility. For businesses planning years ahead, the fundamental question remains: what happens next? Without clear, long-term answers, financial markets stay unsettled, major capital investments are put on hold, and consumer prices continue to creep upward. The primary purpose of this visit is to ensure trade and supply continuity, particularly for semiconductors, advanced display panels, electric vehicle battery materials, and precision machine parts. In today's hyper-connected Indo Pacific supply network, a single product often crosses multiple borders before completion. For example, components are imported from one country, shipped to another for processing, assembled elsewhere, and finally exported to a different market. Even minor disruptions, caused by tariffs, sudden changes in customs procedures, or port delays, can extend financing periods, raising operational costs that eventually show up in consumer prices. This complex reality is why Seoul wants to turn its Beijing file, long a source of unpredictable friction, into a structured, predictable framework. Tariff reductions alone cannot fix the problem. The real obstacles are often the non-tariff barriers that lie beneath the surface. Without absolute clarity on complex regulations, product certification standards, exemptions, and pre-shipment notification requirements, businesses cannot plan the multi-year investments needed for growth. When the supply chain map is unclear, expansion stalls, demand weakens, and crucial productivity gains are delayed. Thus, the Seoul-Beijing discussions will focus heavily on these technical details: quota management, customs duty procedures, pre-notification periods, and penalties for delays. For instance, agreeing on a unified digital customs form could shave days off transit times. These issues may not grab headlines, but they are the gears of global commerce, and their efficiency directly shapes domestic market prices. Semiconductors remain at the absolute core of the challenge. South Korea's chip industry is caught in a strategic tug-of-war. On one side, they supply the United States with the most advanced, high-performance chips for AI and data centers. On the other, they supply China with massive volumes of memory chips for consumer electronics. This dual dependency creates a precarious balancing act. Fluctuating US tariffs and export controls aimed at China create immense long-term uncertainty, making it nearly impossible to sign multi-year supply contracts with confidence. To cope, companies are tightening inventories in the short term, even if it means risking stockouts. They are diversifying trade routes in the medium term to avoid bottlenecks, and for the long term, they are redesigning their entire supply chains, often adopting China Plus One strategies. This visit aims to create a stable foundation with Beijing to support all three of these essential strategies. Logistics form the second critical pillar of discussions. Small adjustments in port operations and shipping routes can significantly reduce costs. For example, by harmonizing digital paperwork between major ports, they can cut docking times, which directly reduces financing burdens. Clearer customs procedures, like a green lane for trusted traders, make delivery schedules more predictable. Together, These seemingly minor improvements reduce friction and alleviate pricing pressure on consumers. The third pillar is market diversification. While China's vast consumer base and manufacturing capacity are vital, over-reliance on a single market creates profound vulnerability. Korean companies are therefore aggressively expanding into the fast-growing markets of Southeast Asia and India, tapping into their burgeoning middle class. This isn't about abandoning China, but rebalancing the portfolio. This multi-door approach acts as a crucial buffer against tariff shocks and global market turbulence. How this affects the US is another key question. The most direct impact of rising tariffs is the long-term cost pressure on American consumers. These aren't always dramatic spikes. More often, it's a slow, steady accumulation of small price increases that become the new norm. If Asia's trade flows become smoother, Korean companies can absorb more of these tariff costs, temporarily shielding US consumers. But without such adjustments, they will be forced to pass the costs on, risking sudden sharp price hikes that could undermine consumer confidence and strain household budgets. Domestic producers are not entirely insulated either. Modern production relies heavily on imported inputs, from packaging and raw materials to specialized machinery and even software. A made-in-the-USA product often contains components from many countries. Therefore, US tariffs raise costs not only for finished foreign goods, but also for local products that depend on global supply chains. In the short term, existing inventories and contracts can help absorb these shocks. But over time, as those buffers run out, business margins erode, threatening competitiveness. Keeping trade flows steady and inexpensive is therefore critical. On the investment side, uncertainty slows progress. Companies delay opening new production lines, automation projects, and factory expansions. This hesitation weakens productivity growth and keeps per-unit costs high, which ultimately fuels inflation. By contrast, predictable tariff policies and clear rules encourage investment. That investment cuts unit costs and improves competitiveness. If the Seoul-Beijing talks succeed in clarifying these technical frameworks, businesses could enter the next quarter with renewed confidence and the momentum to greenlight these delayed projects. So, is this a bypass of the US? It's more about creating alternative trade corridors than about abandoning America. Seoul's priority is risk management, reducing overdependence on one route. Beijing's aim is more strategic, strengthening regional integration. Neither side is seeking a complete break from the US. North America will remain dominant in advanced technology and high-value services. But the stronger and more fluid the Indo Pacific trade network becomes, the weaker Washington's leverage over delivery schedules and pricing will be. Its ability to use economic pressure to dictate terms will diminish. That, in turn, could mean higher costs and slower deliveries for US markets in the medium term.